common misconception that buyers have, sellers have, and even my agents often have is that a seller can give cash back to the buyer on the closing disclosure in lieu of things like repairs or a carpet allowance. This is not allowed. Hi, this is Recharging with Champions. I'm your host, Charlotte Harrill, and today we are going to discuss the fine line between what is allowed on a contract for the seller to pay on behalf of the buyer and what is not allowed. And let's talk a little bit about why. A seller is 100% allowed to pay for some of the buyer's closing costs. In every transaction, there is an amount that is allowable for the seller to pay on behalf of the buyer that goes directly to those closing costs, which of course puts extra money in the pocket of the buyer, but it is not money coming from the seller directly to the buyer at closing. It's just the buyer didn't have to pay those closing costs, so they got to save some money. That is allowed, and there's different rules. We have lots of videos about seller paid closing costs on this channel. Go check them out. But a seller cannot give money from the proceeds of their sale back to the buyer as cash. We see this a lot when there is maybe a carpet allowance or some repairs that need to be done in the house and the seller doesn't want to do them prior to close. The lender didn't require them. So the buyer's just like, hey, just give me a check, right? Put it on a CD, give me the money back. We cannot do that. The seller cannot give cash money back to the buyer. Now, a cool loophole here is the seller can give money to the repair person that's going to be doing the repairs. So if you were going to have carpet done, then write that check, have that CD, have it go to the carpet person or the repair person that's going to be doing the work. That is allowed. It just can't go as cash back to the buyer. The reason for this really comes from back in 2000, 2007, 2008, a lot of pushed appraisals that were allowing sellers to give money back to the buyers, and that buyers were using that as their statutory investment. Statutory investment is just the money that is required based on the loan, whether that be 3.5%, 5%, 10%, 20%, whatever the loan to value is. That statutory investment is how much the buyer must bring to the closing. So back in the day, before there was rules, the seller was actually giving the buyer the money for the down payment, which was causing appraisals to be maybe jacked up a little higher than they should have been. And lo and behold, 2008, we have an appraisal issue because values went bloop down because they were maybe pushed a little higher than they should have been in the first place. So that is what we saw, and that's what created this rule. So just understand that sellers cannot give cash back to the buyers. CD can't have a credit of cash going from the sellers to the buy side or really any party. So even an agent can't give cash back to the buyer unless the buyer is the agent, but that's a whole nother story. The bottom line is only things that are being paid on behalf of the buyer can be put on the closing disclosure. And there are some limits to that, but each loan has different rules. Go check out some of the other videos if you have questions about this. By the way, agents, lenders, if you would like to make a video about this and want a script that goes along these same lines, please remember to check out rechargingwithchampions.com. Go into the members area. You're going to see in the April scripts all of the April ideas, including this one. We'll see you tomorrow.